Everyone nowadays is saying that the stock market P ratio is super high and the P ratio cannot be this high and the stock market is going to crash because the P ratio is super expensive. The stocks are overbought, the prices are too expensive, and I'm here to tell you that I don't think so. I disagree with the statement that the P ratio is too high. But first, let me start by showing you here what do people mean when the P ratio is high. What we have here is the S&P 500 chart, and at the bottom we have the Shiller's P ratio, which is a better form of the P ratio, price to earnings ratio. So what is the P ratio? P ratio is basically the price divided by the earnings of these companies. In this case, the S&P 500 represents the 500 biggest companies in the US, and you have the price of the S&P 500 divided by the earnings of all these companies. And as you can see here at the bottom, the P ratio at the moment of the S&P 500 is 31. It was already higher in the past. It went to 40 at the peak of the bull market in January 2022. If you thought like, oh, P ratio is too high and you sold when the previous P ratio was at 30, let me see how much you'll have missed in the market. You'll have missed a 45% increase in the stock market. But this is not exactly the reason why I don't like to look at the P ratio. It's because P ratio is a valuation model, and P ratios and valuation models need to evolve over time. When people say that the P ratio of 30-something is expensive or is high, it's compared to previous P ratios. It's compared to the last 100 years. And yes, if I compare to the P ratios of, like, let me show you here. I put a 3-month chart. Yeah, the P ratios compared to 100 years ago. Yeah, 100 years ago, they were way lower. And now they are way higher. But there is a very good reason for that, and that's what I want to talk in this video. We cannot use the same metrics to say that the P ratio is expensive because many things have changed. So reason number one, in my view, is that you have now way more investors in the market than what you used to have in the past. We are reaching all-time high in terms of the number of retail investors in the market because apps like Revolut and TradingView and Interactive Brokers and so on, they make it very, very easy to invest, for people to invest. You can open an account in 5 minutes with your mobile phone and boom, you start trading. So now we have way more investors, which increases the buying pressure in the market and increases the stock prices. That's just normal. The second reason, and I think it's one of the most important reasons, is that innovation boosts the P ratios. Innovation boosts the P ratios because now you have better technology. This technology is more efficient, which lowers the cost of the companies, which increases the earnings of the companies, which leads to higher P ratios. So it's normal, of course, that innovative technological companies have higher P ratios than companies 30 years ago which were not so tech-oriented. And I have made a couple of charts. I'm going to share here in the description of the video the links for these articles. What you see here are the different technological trends, the different innovation trends in the market, right? You have the first wave, the second wave, steam power, rail, steel, the third wave, electricity, chemicals, combustion engine, fourth wave, petrochemicals, aviation, electronics, the fifth wave, which was led by the internet, software, and new media, and now we are living a sixth innovation wave, which is AI and IoT, crypto, robots, automation, digitization, and so on. And every time you have a new innovation cycle, you have big efficiency leaps. Companies are more efficient. They reduce the cost. They can produce more. They can have higher earnings. And consequently, they can have higher P ratios. So this is something that people are really not thinking when they say that the P ratio now is like 30-something. Yeah, of course, the P ratio now is higher than what we used to have 50 years ago when there was no tech companies or the technologies were way less scalable. Of course, there was tech companies, but technology was way less scalable, right? If you are, for example, a car manufacturer, you cannot spin up a website and in a week you are selling cars to 1 million people. While a tech company, a social media company, they can spin up a website and in a week they can get, boom, 1 million clients. And this is really, really a big difference. So really, take a look at this chart because I think it's quite important. And another thing that I want to share with you is, You need to compare apples to apples. I also made this chart here. These are the biggest companies in 1990, so like 30 something years ago. And these are the biggest companies now. And the biggest companies back then in 30 something years ago, look at their PE ratios. But also look at their sector. So you have General Motors, Ford, like auto companies, P ratios 4 and 11 respectively. ExxonMobil, IBM, General Electric, Altria, DuPont, Chevron, Shell, and Procter and Gamble. So these companies are all, oil companies, auto companies, like different business sectors. They are not really like tech intensive companies. And now when you look at the biggest companies now, they are majority tech companies. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. These are all tech companies, and that's why they have very high PE ratios, because they have provided the market with big efficiency leaps. They are highly scalable, and they can reach millions and millions and millions of customers all around the world. And they have very big potential to grow. So, yeah, this is why nowadays the stock market has a high PE ratio, because the biggest companies now, their average PE ratio, as you can see here, is totally different of what used to be 30 years ago. But it doesn't mean that these companies are expensive. It means that they are highly scalable, highly technological, highly efficient, and people believe that they can have a good future and continue to scale up in the future. Awesome. Another important reason why the P ratios are now higher than used to be 50 years ago, and we cannot compare them, is that now companies do way more stock buybacks. So 20, 30, 40 years ago, companies used to pay dividends. So every quarter or every month or every year, depending, they would pay a little bit of their profits to the shareholders. And this dividend yield could be 1, 2, 3, 4, 5% of the value of the stock. Now, companies, to be more tax efficient, instead of paying dividends, they do stock buybacks. So instead of using that money to pay directly to the shareholders, they use that money to buy the stocks. And when they buy the stocks, they increase the scarcity of the stocks, they increase the price of the stocks. And at the end, the stockholders, the shareholders will also profit from this, right? So what I cover here in this article, you can see in this chart, stock buybacks are now at all-time high, meaning that, again, this is one more reason why the P ratios go up, because stock buybacks make the price of the stocks higher. And instead of distributing dividends, they are just pumping up the price of the stocks, which makes the price of the stocks higher. So here in this chart, you can see the normal S&P 500 in general, in green, and in blue, the S&P 500 buyback index. And you can see that the S&P 500 with the buybacks is way higher than the S&P 500 without the buybacks. So yes, one more reason why the PE ratios are now way higher, and we cannot compare them compared to what they used to be like 30 years ago. Finally, another reason why the PE ratios are high is tangible versus intangible assets. So what you can see here is that 40, 50 years ago, most of the assets in companies will be tangible assets. What are tangible assets? They are machinery, factories, property, like physical goods. Because, businesses 40, 50 years ago were like factories, like hardcore brick and mortar businesses where they need to buy a lot of machinery. You need to buy stuff to build stuff. Now, businesses, as you can see here, have way more intangible assets. What are intangible assets? They are patents, they are software, miscellaneous software, data. And companies make a lot of money with software and data. So this is very important, because 50 years ago or 40 or 30 years ago, you have these companies here, the biggest companies in the world. They are very tangible assets intensive. So they need to buy factories, they need to have huge infrastructure, machinery, and so on. Now, the biggest companies now, they don't need to buy any of that stuff. Their value comes from software, and software can scale up very easily again, right? If Ford or General Motors or a car company wants to have 1 million new clients tomorrow, to get 1 million new clients, they need to buy machinery, they need to buy factories. It takes 3 years to build that factory. Is not that easy. It requires a lot of resources and costs a lot of money. If Amazon or Facebook or Alphabet, Google want to have 1 million new clients tomorrow, yeah, they spin up a new server on the cloud and boom, they have it tomorrow with barely increasing their costs. So yeah, this is why the P ratios are now way higher, because companies, yes, they have so much potential to grow without the need of growing their costs. So I'll say it's very misleading to look at the P ratios and say, oh, stocks are too expensive or too cheap, or even big people like Michael Burry, like, look at the P ratios and say that the stocks are too expensive. But I'll probably dismiss the P ratio. Of course, you can continue to look at it, but you cannot don't rely on the P ratio uh, to say that the stock market is too expensive or too cheap, because we are now living in new times, and innovation brings new P ratios, new efficiency frontiers. And we cannot really look at the P ratio the same way we used to look at it 50 years ago. All right, if you want more details on this topic, I have written a long article on Medium. I'm going to leave the link in the description of the video. If you enjoyed the video, give it a like and subscribe, and keep tuned for more investment cool stuff and crypto and stocks and so on. All right, I'll see you in the next video.